Also out of the world of VanEck is this report that you guys wrote, which is going to be the subject of today's podcast. Report titled ETH 2030 Price Targets and Optimal Portfolio Allocations. And as soon as anyone opens up this report, you see some pretty bullish numbers for ETH, the asset. There's a base case, a bull case, and a bear case, of course. And the bull case goes all the way up to $154,000 Ether by 2030, which are, like, me and Ryan are pretty bullish here at Bankless, but that's a large number. So we kind of want to unpack this report, like talk about how you actually came to these numbers, and also like who is this report for and what is its purpose. So maybe you can start with that. What's the why behind this report? Like, why produce these things? Who is this report for? What's the point?
Yeah, well, now that the SEC has at least theoretically approved spot Ethereum ETFs to trade, it's obviously important to explain the investment case for this asset. Overall, there's a bigger market for income producing assets than there are for inert assets like Bitcoin. So it's not impossible that, in a decade, the market for an Ethereum ETF could be bigger than Bitcoin. But in the meantime, we have to educate traditional finance market participants as to why this asset matters. There's a lot of analogies that have been attempted, and the one that we've honed in on is open source app store. So we think that Ethereum is a productive asset that lets anyone open a storefront on this network, and they can do so at a lower take rate than big tech currently charges. So it's an open source app store with payments functionality bundled in essentially for free. And we wanted to explain the mechanics of how that works and put some numbers around the P&L, the profit and loss statement of Ethereum. So we went through this model with you guys, maybe it was about a year ago, and now we have updated it to consider, I guess, two major changes. The first is that we have increased our overall penetration rates for open source databases, and we expect that in aggregate, these open source digital assets can intermediate about 7% of the current top line of financial applications like payments, borrowing, and lending, and that's up from 5% in our previous model. The basic idea is that the political backdrop has improved and block space demand is somewhat higher than we initially anticipated. The other change is that we increased the take rate that we expect the Ethereum ecosystem to earn from all of this application activity from 3% to 5%. These are still quite small numbers in the context of what, say, the Apple App Store charges or Google Play. So those are the major changes that get us to this $22,000 base case. It still assumes, the model still assumes, and we do this for all of our layer ones, that in order to achieve the base case, the project has to achieve about a 70% market share of all layer ones. So we have this kind of guiding light that these networks have a lot of winner-take-all characteristics, and one or two platforms are likely to capture the majority of that, and we're trying to own these call options and then probability weight the chance of achieving that 70% market share. So that part is unchanged, but for context's sake, Ethereum's market share over the last 12 months is 58%. That's market share of fees paid by users. So there is
two networks, two protocols.
Correct. Yeah. So there is some lifting to do to execute on the scaling roadmap and get folks actually using these L2s.
So yeah, just so you brought up some of the previous context here. A year ago, you guys had a pretty similar report where you had a base case of $11,800 by 2030 for ETH. In this report, that base case has gone up to $22,000, so basically 2xing. I just want to unpack that change between your guys' analysis last year versus this year. Was that because of you guys are getting more increasingly bullish on crypto, the category, or Ethereum, the network, or a little bit of both? Maybe you can unpack that a little bit more.
Yeah, it's a little bit of both. So the two parts of the model that we changed that had the biggest impact on the price target. The first is that we take a look at the end markets that open source databases might go after, and we basically segment them into four. The first is finance, banking, and payments. So traditional, financial sector applications. That is by far the largest. The second is marketing, advertising, social, and gaming. So I'd roughly call that metaverse. The third is infrastructure applications, and the fourth is AI. And we have penetration rates for each of those four sectors that we think crypto can achieve. The one sector that we increased was finance from 5% to 7.5%. Part of that is just realizing that we're in the middle of a bull market that we think is going to accelerate with the November election of President Trump, hopefully. That should increase the overall available market for crypto assets. And then for ETH specifically, the first model was made before the Dencun fork. So recognizing some of the scaling progress that ETH has made, that accounts for the larger take rate that we have for the Ethereum network overall, which goes from 3% to 5%. I guess if there's a third, it's we introduced our AI estimates into this piece, and we have a separate report on how AI and crypto intersect, but that's a relatively small adjustment. The biggest is the penetration rate of finance.
To continue leveling up your crypto game, then you need to get on the Bankless newsletter. It's the world's most popular crypto email and is completely free. Just click below to sign up.